My guest today is a market master whom we invite for her mastery over markets. That she's a woman, of course, makes it a double delight. Joining me today is Devina Mehra, founder, chairperson and managing director at First Global and author of the very popular book Money, Myths and Mantras, which has gone into reprint in under a couple of months, or in just a month, right?
Just a month, yeah.
Okay. Many congratulations for that.
Thank you.
Yes, here's one reader of the book. Well, I'm going to ask you, begin with a very unique and absolutely unasked question. Has the market bottomed out?
क्या लगता है market, as I say?
Exactly.
Eternal question.
Eternal question.
So,
But now the eternal question has become more persistent because of the slings of the last 4 months.
yes. So, I mean, again, nothing unexpected. Just this morning, I was looking at somebody had posted the CNBC video from 2009, Nifty circuit up 20% on the.
On March of 2009, yes.
Yeah, no, this is that the return of UPA. So
Okay.
Singh is king.
Okay.
And before that, if you go back another 5 years, it was circuit down when UPA came for the first time. So as most things, this too shall pass.
Yes.
But I mean, coming back to the basic question, as far as the large cap mainstream indices are concerned, I think now the risk is on the other side, that if you stay out, you will miss out on the upside. So now you are in that zone. Nobody catches the exact bottom, but definitely you are in that zone. And this is data I've been talking about for the last several years, which is that in 40 odd years of investing, if you miss out on the 10 best days, you miss out on 2/3 of the returns. So if your 100 rupees had become 75,000, now you'll be down to 25,000. If you miss out on the 30 best days, you miss out on 90% of the returns. And it's the same pattern. If you look at the S&P, it will be the same. And so everybody understands the risks of being invested and losing money, but there's also a risk to not being invested. So to the extent, whatever is your equity allocation, which should never be 100%, you should be invested. But the other part of the market, which again, I was looking at least from last July, I've been talking about it, that the small cap, micro cap, and also some other areas where you had these thematic funds, those are the areas which may not come back, because in every bull run and then there is a fall, and the next bull run, it is not the same stocks that come back. And just on the 10 best days, one other thing, that those 10 best days always come when there is fear and uncertainty, where people are asking that should I remain invested, should I stop my SIPs. They don't come when there is optimism and buoyancy and everything looks good, as it was the case in most of 2024.
So it's set. When in your article, I saw the Mint article, stay put or exit, it's clearly stay put, going by the historical
But
evidence.
not necessarily in where you are invested just now. Never wait to make it back in the same stock.
I was going to push this question behind, but let me drag it forward.
Yeah.
I read that bit also. What has just performed very well may not be, will not usually be.
Right.
Now, one of the big themes of the last 2 years have been e-commerce, for instance. I mean, Nykaa, Swiggy, Zomato, they've all given very good returns. Would this apply even to stocks like that?
Yeah, I would not. I mean, this is not where we are invested in the first place. So I may not know the exact details
no,
for
I'm just
every
asking you
company.
broadly.
But broadly, yes. I mean, it is. See, people think that one category of themes not returning is stocks which disappear into the blue yonder, as I say. So, because many more stocks have listed over the years than what trade currently.
Yes.
But there's also a category of stocks where the businesses might keep running. DLF being a good example, very coveted IPO, and just it was above IPO price for just, I think, a couple of months after listing, and then didn't see years, decade plus, it did not see that price. So it is always many of these stocks that you mentioned are still relatively higher priced if you compare with the global peers and all that. So it doesn't mean that you think the business is going to be a disaster, but the stocks may not still perform.
What are the specific themes we should avoid? We saw defense, we saw PSU. Which are the themes that, you would be wary that it will...
So, I mean, we are fairly stock specific, and I think right now it is also a stock specific market. But in terms of, I will tell you where we are overweight and where we've been overweight for a while, which is IT, pharma, auto components. In the last couple of rebalances, we've added some in FMCG, we've added some in chemicals. Banks, we are still underweight, but we have added some, banks and financials. So that would be broadly it. In terms of what we have avoided, there have been pockets of energy, there have been real estate we normally avoid also as a high risk sector, and our systems also never liked it. Paints was another area which we've avoided. So that broadly still continues.
Okay. Well, since you said, auto ancillaries, pharma,
Right.
aren't those the ones that could get affected because of the tariff issue?
Yes, I mean, that
you
is,
have, so you would be very stock specific in these areas?
Yes, and I mean, that is, to some extent, the bad news is now in the price. Of course, the way Trump plays it, he announces these tariffs and then he rolls it back. He uses it as a negotiating tool. And if you look at the rest of what he talks about, that the common American has seen their costs go up, and healthcare is, in the US, it is one area which is where US spends the most and gets the worst outcomes. More or less among the developed nations, it has the worst life expectancy, infant mortality, it all, and yet it spends highest per capita. And India has been a source of cheaper medication. So do you really want to tax that?
Mess it up,
Yeah.
I can imagine. So we have, pharma may still stand a chance. Okay, I take your point about being stock specific. The other theme that people are talking about is metals. I mean, one hears it being said because there is a chance that Europe will rebuild. The wars will, Trump is determined to keep wars at bay. Anyway, your view is not a very sexy sector, but has its time come under the sun?
Not really. No, I mean, we don't think it's going to be a really bad sector, but it's not looking particularly great. And I mean, there is a second order effect of Trump tariffs on metals, which is that India itself doesn't export much metal. But if they put tariffs on, let's say, China, so then India becomes the dumping ground. So that's the second order impact which is possible, and which is also keeping us a little wary of the metal plays.
Okay. Well, the other point before I came to the themes, the big question I wanted to ask you is this US exceptionalism and rise of Europe. Is US exceptionalism at an end?
See, first of all, as far as investing is concerned, one thing I say is that no theme lasts forever. No geography, no asset class, no sector within a country, nothing lasts forever. And the US has been an outperformer for the last 10, 12 years. And we were always watching that, when is that going to change? We thought it may be still some time, but I think Trump is kind of hastening the end of US outperformance, maybe. I mean, in our last rebalance.
So it's fading.
Yeah, we have we've gone not massively, but we've gone somewhat underweight US in our global funds. We've gone overweight Europe. Europe has been doing well, and again, long period of underperformance, maybe that comes to an end. And the narratives always follow. I always say that, like 2003 to 7 is a period when emerging markets outperformed the US massively. I mean, emerging market index went up 3.5 times.
And then the BRICS narrative.
BRICS narrative was, and it's going to be the century of India and China and all of that. And then when US market started to outperform, that was forgotten. So the stories always follow. But US is doing something which is really beyond just investing. I think, they are, and that's the part that scares me, that it is not about investing, but that, the world order as it stood post-World War II is, I mean, there were, of course, many nasty things the US and its allies did in the Middle East, for instance, or even what is now happening in Palestine. But that apart, largely,
based order.
Yeah, I mean, the whole world was kind of balanced, and that is changed. Even on trade, I heard a finance minister say that one thing which has fundamentally changed is that the multilateral organizations like WTO no longer work. We have to have bilaterals with everyone. So many things are changing, and the world peace part is where I am getting a little jittery, that, how does that play out when everybody has their own nuclear weapons, and you have dozens of madmen with their finger on the nuclear button.
No, I know. We are not talking enough about it. We are only talking about tariffs, but that is the downside when the rules order changes.
Right. I had posted on this. I mean, that's the scary part.
Yes. Okay, let me get back to economics because people want to hear you about that.
Right.
Which may be the funding economies? If Europe and now even China are the economies to which money is flowing, which may be the economies or markets from which money will go? Will it be India? Will it continue to be India?
See, first of all, I don't spend a lot of time thinking about this, that where will the money come from for Indian markets, because I mean, the subtext to anybody asking that will FII invest or take out money is that if FIIs invest, the Indian market goes up. If they take out money, the Indian market goes down. This time it has been coincident that yes, they sold and the market went down. But if you look at the long-term data, there is no correlation. I mean, that's something we monitored for a long time and we found there is no correlation. And this is right from the beginning. I mean, the FIs started investing in 1994, and 94 to 2003 is the only 9-year period in the Sensex history with a net zero return.
Oh.
So there's like that much money which came in. There was no domestic mutual fund or institution to speak of other than the UTIs and LICs. And yet that money did not drive the market up. So it is, there is a disconnect.
That's a big consolation for people who believe that markets will run only with FII money.
No, that's the data. Yeah. I mean, that's
fair point. Fair point. No, the reason why I asked you was not whether FIIs will come in, but will the pull-out continue? If, China and Europe become the go-to market, okay, as you said, some money you pulled out from US and put it in Europe.
Right.
Will FIIs continue to use India as the funding market to fund their new investments in China?
I don't think that's the real reason. If at all, on the margin, FIIs, if you look at one, of course, is rupee depreciation. So their dollar returns have been coming down. And if you are making the returns, then we have a capital gains tax, which other markets don't have. So on the margin, you can say those are the factors. And so I don't think that to invest in Europe necessarily, that they might take money out of US to invest in Europe.
Yes, we hope that. We hope that US exceptionalism will not draw money, at least from our country. If it is fading, then that much may be good news. We don't know. But thank you very much, Devina Mehra, for the fund of themes and topics within India that you have discussed with us. It's a pleasure having you with us, and we will, of course, have you even after the International Women's Day theme is over. And many congratulations on your book.
Thank you. Thank you.